Hey, John. Well, JP Morgan as well as Wells Fargo will be first out the gate come Friday morning around 7 a.m. Eastern time. You'll also get Citi on Friday, and then Goldman, Morgan Stanley, Bank of America. All will be coming throughout the following week. Big focus point this quarter is going to be on investment banking. What do those advisory fees look like amid a global boom in M&A? JP Morgan last month said that it expects fees to be up 35% in the fourth quarter, though trading is expected to be down 10%. Declines there likely to be seen across the banks as the pandemic-era volatility starts to subside. We'll also keep an eye on loan growth as well as net interest income and the outlook around that in a higher rate environment. Put it all together, and the banks collectively are expected to pull in about $30 billion in income in the fourth quarter. JP Morgan leading that with an estimate near $9 billion. Bank of America at 6.4. Citi, Morgan Stanley, Goldman Sachs, Wells Fargo, all in the $3 to $4 billion ballpark. And looking at the financial sector as a whole, fourth quarter profits are expected to grow more than 11%, which ranks it third among the sectors in the S&P 500. Tech and healthcare, of course, both expected to see earnings up by more than a quarter, and the S&P 500 in its entirety is expected to see EPS growth of about 19.8%. That would be the fourth consecutive quarter of double-digit earnings growth, John, even if it is a decline from the 37% growth we saw in the third quarter.
Kelly Leinz, thank you. Kailey, thank you very much. Victoria, I want to come to you. You said a little bit earlier on, I hope we can focus on the earnings. Something like that anyway. I want to build on that just a little bit more. Just get away from the Fed chat, focus on the earnings starting this Friday with JP Morgan. What's the playbook for you going into earnings season, Victoria? What are you looking for?
Well, first off, we're looking a lot at forecasts. I'd love to know what they think going forward, what their plans are, and if they can continue to do margin growth. I think, honestly, financials are going to come in strong. You've got consumers with great, healthy balance sheets. Rising rates are great for their internal margins. The one thing I am going to watch is a slowdown in mortgage and mortgage applications. You saw Rocket Mortgage kind of struggle with that a little bit. That maybe this great refinancing boom, as rates are coming up, you may see a little bit less on the mortgage side. But I think the banks are going to come in strong, and I'm very much looking also into their forward guidance. I think one of the reasons we're also wary of tech is you kind of talked about, okay, we're at the fourth consecutive quarter of double-digit EPS growth. But the problem is if growth is slowing a little bit, tech companies get punished mercilessly, even if they beat, but they have a bad forward-looking outlook, or if they beat, but they beat by maybe a little bit less than anticipated, or their growth is slowing a little bit, even if they're still growing at a great pace, their pace of growth is slowing. I think you're going to see some potential punishment in there. We remain buyers of dips. I think there's a lot of capital still on the sidelines. We're looking at opportunities to continue to put capital work at good valuations. So I think you may see some headline misses, but I think financials and energy, honestly, are going to be strong. I'm a little wary what tech's going to do. Tech last time, the big names really struggled. You remember Amazon when they reported? I mean, even though they reported record profits, they got absolutely pummeled for warning on their forward guidance.
Stuart, Kaiser, same question to you.
Yeah, I mean, I think, I think Victoria makes a lot of great points. If you look at the pattern last year of earnings, it was generally, consensus was too low going into the season. You got a pretty substantial beat of consensus, yet consensus refused to take up kind of the forward quarters. And I think we're kind of in the same situation here where the number kind of looks a little bit too low. We'll probably get a beat. And then the question is, what do you think, to Victoria's point, of the forward outlook? So, what are banks telling you about the pipeline? What are tech companies telling you about forward earnings guidance? From our perspective, I think we probably like being long tech into earnings or long the market into earnings. We do think you're going to get a pretty big beat of consensus, and that should stabilize that. A lot of what we saw last year was similar to that. The high quality, large cap tech, they generally speaking, obviously there were some blips, but generally speaking, did pretty well during earnings because it was a reminder that these are just, free cash flow generating monsters that are generating a lot of earnings growth. So, our view is generally that earnings should probably skew positive to the market. And to Victoria's point, it's the outlook that's going to matter. And we'll see what happens there. We're looking at the NASDAQ VIX relative to the S&P VIX to get a sense for how much risk premium is priced into tech. And that spread's fairly wide right now. And hopefully tech, earnings help close that down a little bit.
Michael Kushma, that's the earnings story. Let's talk about the data. Finally, CPI Wednesday, retail sales Friday, a sneak peek of Wednesday, year over year could have a 7 handle. Is that what you're looking for too?
I think so. I think we're going to be 7% handle. We may have a 7% handle for a month or two before we finally peak. And the data, again, the global indications as well as the U.S. indications that inflation is much more persistent on not just persistent at the levels, but the rate of change up. And it's been difficult to forecast any kind of moderation in that number. So I think it's going to continue to drift higher for this month and next month.